All right, ready to get started again? You can take your seats, or if you don't want to take your seats, you can stand up. I don't care. We'll keep this really informal. How about that, okay? You can stand up, you can sit down, you can mill around, but you got to be quiet and turn your cell phones off. All right? Everybody ready? We just have one more presentation. That's me, Doug Woodward. I'll be talking about regional conditions actually on the program. It says regional competitiveness challenges facing the Midlands, and I'm going to get to that, but I changed the title, Economic Outlook, the Great Expansion in the Roaring Twenties. But as you know, our dean doesn't like that, so I'm going to have to change that back. But he's not here now. But I do believe we're going to see some Roaring Twenties. But a lot of people don't know that the 1920s actually began with a recession, and then we had this big expansion, and then you had the crash in 1929. But that history isn't going to repeat itself. We're just going to have steady growth continuing going on through this next decade. But I like to give decades a name, you know, and we used to do that, swinging 60s, you know, roaring 20s. We don't do that anymore. This last decade, there was no name for it. So I'm going to give it a name, the Great Expansion. Remember the Great Recession? Everybody gave that a name. That only lasted 2 years or less, but we had 10 years of growth. This will be remembered in history, at least in economic history, as one of the best periods of prosperity in the United States. What we just experienced, believe it or not. I know it was slow growth, but it was steady growth. And now, incredibly, we are down in this state to 2.6% unemployment. If I told you this 10 years, and I was here 10 years ago, if I told you in 10 years we'd have 2.6% unemployment, when the unemployment rate, Joey, was at that time 11.6%, double digits, you know, people would have just been shocked to hear that. You know, now I hear complaints, you know, oh, boomer, you know, I hear from the students, from the young people, boomers left us this bad economy. Okay, boomer, you heard this? Okay, boomer. They should be, okay, boomer, thank you. This is the best job market ever, right? They should be thanking us. They're living through this time. Our graduates are going out into a fantastic job market. That wasn't true in 2008. So that's how much progress we've made. And whether we'll see the Roaring Twenties or not, I'll have to come back in 10 years to see if we make it and don't crash. But right now, as we heard from Joey Van Nessen and Sarah House, everybody's on the same page pretty much right now. Actually, it's kind of scary when you think about it. You know, maybe there's time for a shock here, but things are looking good. And I want to pick up on that theme today. Give you a little overview of what I'm going to talk about here. And I'm going to be pretty brief. Hopefully we'll have some time for some questions. But I'm going to start with my perspective on looking ahead, like Joey and like Sarah, the challenges facing, especially the South Carolina economy and this aging expansion with slow economic growth. And I want to emphasize something that could have been lost in the previous discussions. But this is a bit of a concern for mine. It's a leading indicator. And there's a falling growth in private investment, and that's true around the country, and it's true in South Carolina. So I want to talk about that, so you don't think I'm too Pollyanna and too optimistic. Because I do see some issues there that indicate some real significant slowdown ahead in the early 20s. But looking back too, I want to look at our regions and what's been going on. I can't cover every region, so I can't talk about all counties in the state and all cities. I'm going to hit the major metros in this reflection on regional performance in South Carolina. 10 years after the Great Recession, how have we done? Who have been the winners in this long economic marathon that's been going on now for a decade or more? And to look at just three basic, the most fundamental things that matter. What's happening to our population? Is it growing? What's happening to employment? Has it expanded in metro areas? We know it's been expanding overall. What's been the differences there? Who have been the winners in this race of economic development? And I want to look at what's so important is the standard of living, overall standard of living, our income standards. Have they been rising? again, if you talk to most young people, they think we're leaving them the worst economy ever, and the standard of living is plummeting. So I want to provide a little bit of data. We don't have time to get into all the details. There's a lot of nuances there, but I do want to talk about what's happening with population in this state and its regions, employment, and our standard of living. And finally, given that our new President Caslen was here talking about the role that higher education plays, I want to come back to that to conclude our conference, talk a little bit about where our graduates are going, and the very important role that our universities play in continuing our economic growth story for the Roaring 20s. So again, I'm going to label this the Great Expansion. I think I'm the first person to do it. 2009 to 2019, we know that's behind us now. It did expand the longest on record, at least in the post-war era, and if you go back before that, I think you have a hard time finding anything in the 19th century where we had uninterrupted growth for 10 years. Sustaining this growth, we've been very fortunate. We've had far less financial fragility problems stemming from the financial market like we had in 2007 and 2008. We heard from Sarah, that it still looks pretty good from that point of view. We've had no price shocks. If you go back 10 years ago, on top of everything else, with the financial crisis going on, we had a big spike in gasoline prices. And that, it went up to $4 a gallon. Look at where they are right now. I was at Costco the other day. What are they? $2.07 at Costco, and then you get 4% back, so even better. No shock there. We're not seeing price shocks. In fact, inflation's under control. And this is why I say if we're going to have a trade war, which is potentially inflationary, this would be a good time to have it. Consumers are just not feeling it. That can change. Okay, we'll see what happens. We could see some spike in prices. If I worried about anything, it would be this trade war really gets out of control, and finally we do see some price spikes. Consumers get very nervous, retrench their spending, then we could go into a downward spiral. We'll just have to see how that plays out. But right now, we've gotten through this trade war unscathed, largely, at least in terms of the broader economy. We've had a lot of fiscal stimulus, a lot of government spending. We had it going in from the Obama administration to get us out of the last recession and continuing on with deficit-financed fiscal stimulus, government spending, a lot of it in defense. I want to come back and talk about some of the things that President Caslen was mentioning might be good opportunities for our state because the federal government still is spending money, and we need to get some of that here in South Carolina, especially in the defense area. Finally, we've had easier monetary policy. Incredible. Sarah already went through that, and you all know that story. And we expect that will continue. If there is any problems, we'll just keep cutting interest rates. We'll do more money creation, quantitative easing. As long as there's no inflation, it looks like we can keep that going. So we'll see. Will the 20s roar? Well, we're starting off on a good foot. But we've got some long-run challenges. I want to start with those. Here in the state as well as around the country. And those have to do with investment. And I'm talking about real plant and equipment investment here. I'm not talking about financial investment. This is how we talk about it in the economy. What are business, are they spending? If they're not, that tends to foreshadow slower growth. This is a leading indicator for the economy, and it is slowing. I'll come back to that. Offsetting that is this rise in government spending, a lot of it in defense. So that's been good. That's been stimulating the economy. The question is, can we keep that going, both of these going, with falling investment, and will government spending increase? So let's start by looking at defense spending, since our president was here, President Caslen, but he knows this. This is where the money is. This is where the growth in spending has been dramatic and been growing very rapidly. You see that defense spending declined, and this is the rate of growth of defense spending in the middle of this great expansion. And then it started coming back and growing very rapidly. So there's a lot of money out there. There's a bipartisan agreement now to increase our national defense. And that money is getting out into the economy. And you can see, especially since about 2018, it's continued on, slowed down a little bit. This is a rate of growth very fast. It was growing fast going into the recession, and then slowed down dramatically, but it's come back. And we, we have a very strong presence of the military in this state. And you heard some of the things that President Casson was talking about of helping us get more of that defense budget. We should be. We're military friendly. We've got a strong base of defense activity already. Sometimes we don't get the high end of the defense budget, but we can do better. And he talked about some very specific initiatives that I think can really benefit our state a lot. So I was glad he was here, and he's already working on it, helping us get some of this defense spending here in South Carolina where it should be, given the strength of this and the support that we have for the military and for defense in South Carolina. So that's where the money is. Here's the level of dispense. I was showing the growth. So it's really not that dramatic. This is in real terms. We're looking at defense spending. This is just consumption and what we call gross investment, what they're actually spending. It's not military pensions and all of that. This is where they're actually spending, and it doesn't look all that dramatic. This is adjusted for inflation, but it continues to grow after a dip. The question is, will this continue? And this is one of the questions that we'll see after the outcome next year of the election. If this is something that the new administration that will be coming in, if there is one, will be committed to. My guess is they probably will. There seems to be bipartisan agreement to keep this going, so we should have good connections right now to Washington and know where this money is being spent and how it can benefit our state. And that's exactly what President Casson was talking about in his opening remarks. So that's on the government side. There's a lot of money being spent coming out of the defense budget. Here's on the private sector side, U.S. business investment. What's the private sector doing? This is where I'm a bit concerned. Private investment is falling. This is the rate of growth of plant and equipment investment in the United States. And as you can see, it can plummet like it did in the last recession, going back to the Great Recession, fell off dramatically because when there's no growth in the economy, there is no one that wants to commit to capital outlays, right? But then you see it did come back, dipped a little bit, and then it started to turn up again, investment spending. This came after the tax cuts came in 2016 and into 2017, 2018, so we got a growth boost out of that. Corporate profits tax cut dramatically. We expected more investment. Not all the money from the corporate profits tax is going to go into plant and equipment investment. Some of it, can go to stock buybacks. I mean, they can sit on cash. What we want is them to spend, to build up our productive capacity, and that is starting to decline. It could even go negative, and in some cases, in some quarters, it actually did. If you look at this on a quarterly basis, this is U.S. capital outlays, spending. Look at the top, you see the latest quarters, -3%, -1%. This is a warning sign to me. This is something I'm concerned about. You can see that wasn't true a couple of years ago. We had very vigorous spending going on by the private sector in 2017 into 2018. It continued up through 2019. So this is something new now just happening this fall. We got to keep our eye on this if this continues. Actually, the latest number for October is positive, that's from what I read. So it looks like it's come back a little bit. Maybe this worst of this is behind. But spending on structures, like plants, that's down. We don't hear big announcements right now. We're in this great expansion. Where are the announcements? Before we had announcements of expansions like Volvo earlier in this expansion, but nothing like that right now. I was just talking to Secretary Hitt. Not a lot of capital investment. It's getting tougher and tougher to get these big projects. So spending on structures is down dramatically in the third quarter. Spending on equipment fell as well. So these are going negative, and that does not bode well for the future because business investment is so important. It's not the largest part of our GDP, as we've heard before. That's consumption. That's 70%. This is in the range of 15% of our GDP. But this is our seed corn. This is what we don't consume now that we're saving for the future, we're putting into the ground to help grow our economy in the future. And we need to keep doing that if we want to have higher productivity, and long-run economic growth. That's why it's important, not because it's the biggest part of spending, because it really indicates where we're going to be in the future. If we don't invest, not in good shape. So we're just starting to see that trend down a little bit, this less spending on equipment and structures. This also includes, by the way, computers, software, research and development, all these things we need to make a more productive economy. So that's the biggest concern I have, and I don't think we emphasized that enough earlier, but I'm not predicting this negative trend will continue. But if it does, going into 2020, then I will raise the specter of the R word, the recession, because this is a forward-looking indicator. So I'm going to keep looking at that before you think I'm too much of a Pollyanna. I'm going to keep monitoring this. I think we all should look at investment spending. Here's the level of investment spending. Again, the same thing before. We're looking at the rate of growth. It barely registers. You see, it's been up. But this is in real inflation-adjusted terms. Grew throughout this decade, and is just now on the cusp of turning down. So a bit of a concern there. And here's U.S. investment growth. I wanted to look at manufacturing output, too. This is one of the areas where we do see a lot of investment. We have traditionally in South Carolina. We're a manufacturing-oriented state. We're not seeing much of that for the reasons we've seen slowdown in employment in manufacturing, especially when you look at the contingent labor force that Dr. Van Nessen was talking about. That's down. But manufacturing output usually holds up even when employment is going down. But output is starting now just to turn down, and this is U.S., but also in South Carolina, partly as a result of the trade war, but not just of that. Most manufacturers, they have the capacity that they need right now, so they're not going to invest to meet the demands of the market. And here are the drivers of this business investment. Profits, number one. If companies are profitable, they've got money, there's different things they can do, but part of that is they're going to spend. They're going to spend on plant and equipment or research. They're going to spend on, on many things to make them more productive. So when profits are doing well, investment tends to follow that. As we heard from Sarah, though, profits are down. Profits starting to go down, another concern, so that we could get into a negative feedback loop. Profits are going down, investments going down, profits down even further. This is how you get into a recession. So not a good sign there with profits either, because that's a driver of business investment. Another major driver of investment is anticipated growth. You've got to anticipate in your market or in the economy overall, looking at GDP, when you hear it slowing down, why are you going to invest? You're going to hold back spending. But that's going to create a self-fulfilling prophecy. If they're not spending, we're not going to be hiring workers. They're not going to be spending the workers as much, and we can get into a recession that way as well. This is why this is so pivotal, what's happening with investment. The anticipated growth slowing down, there doesn't seem to be a need to be investing, at least in the short term, the next few years. The final thing has to do with risk-taking. I mean, this is what economists refer to as animal spirits. You've got to have confidence in this economy. I still think there is that. We're a risk-taking capitalist economy, and that's what we're talking about. We're talking about capital. And this is capitalism. Capital is investment. And that's what capitalism is good at, investing for the future, to create a productive economy. But it takes risks to do that. And there's a lot of uncertainty right now that is elevating the level of risk to invest these days. Election is part of that. Who knows what policy changes could happen next year? When you hear what some of the candidates are talking about, President Trump dramatically, under his administration, lowered corporate profits taxes. Could they go back up again? That makes it a really risky environment to be investing right now with this uncertainty. So that's going to curtail some economic activity, I believe, at least on the investment side this year. So you've got private sector decisions, and then you've got public policy too. The lower corporate profits tax, could they go up again? I don't think so. I don't think dramatically, although there are definitely candidates who are proposing just that. Another thing the Trump administration has done that's helped investment has been an accelerated depreciation. They've also reduced the regulatory burden. That could change in the election this year if we get a new regime. But it'll take some time because they'll have to pass new legislation. So there's nothing that affects the outlook going into 2020. That's something that we have to look at next year after the cloud lifts over this election and we see who is the next president. But that's a year away from now. Okay, so those are the drivers of business investment. But overall, it's slowing down and even negative right now. So my outlook for 2020 on investment, just emphasizing this part because I think it needs it. It needs this emphasis. We're at the end of an era in terms of investment spending. Here's an example. German automobile companies. How important are they to this state? We know. Important. Not just BMW. Of course, we got Daimler. Daimler just announced recently that they're cutting back. They're scaling back. Not in, I didn't hear that in South Carolina, but globally, their operations. They're scaling back, cutting jobs and not investing. They see stagnant demand right now in China, the US, and Europe. The auto market grew a lot. Auto sales grew a lot. Now they're kind of leveling off, so they don't need more capacity. They're concerned about the trade war. Another one, that's just Daimler, is Continental, another big investor in this state. Put a major investment, as we know, near Sumter. They just announced tens of thousands of job cuts and no more investment. This is globally, not here, but they're closing plants, including one in the United States in Newport News. All right, closing, reducing capacity. They don't see that they have the need for it. They're certainly not going to be investing and expanding. The other thing about the auto sector being so important in this state, and it's worth mentioning, is a lot of these companies are uncertain about the future, but they know one thing's going to happen. There is going to be a major shift from internal combustion engines, which is what they all do right now and what they do in South Carolina. Actually, they don't make engines in South Carolina. Maybe that's a good thing, because those engines aren't going to be made in the future. We're going to go to electric cars. They all know this. Every time I talk to them, this is what they talk about. This is a long-term strategy they have to make this transition away from internal combustion engines into electric cars. But right now, they don't want to invest more in the kind of vehicles that they're producing because they don't see the market growing over the future. In the future, they will have to make major investments to make this transition, but that's a few years off. But it'll start to happen. But in the next few years, I think that restrains how much investment is going to come from the auto sector. So I don't predict any major announcements, at least of plants being built in the United States, except for the fact that because of tariffs, some of them do have to move more production into the United States. So I'm going to hedge a little bit on that. I can see the United States, these tariffs, and it happened before with the Japanese. When we put restrictions on their trade in the 1980s, that's when the wave of foreign investment started coming in, the auto sector, because of trade restrictions. So there is a possibility we could see some announcements as a result of that. But it's just general uncertainty out there about policy and about the market. Okay? There are some opportunities, though. In the great expansion, we did see a lot of manufacturing investment. We built up our capacity. Another area where we just saw, and the reason these gas prices are so cheap, as we all know, the investment in fracking, in oil and gas and energy, that was really substantial going up to 2015, 2016, but that slowed down. That's bringing investment down, too. There's not as much investment because they, in a sense, overinvested. They're waiting, for the market the prices to rise again. So that was a big part of the story of investment in the great expansion of the last decade. There was also a lot of tech investment. A lot of the investment that is taking place, we don't see as much of it here. We see it in North Carolina. You certainly see it on the West Coast. Is tech investment. It happens, and it's dramatic, and you see dramatic effects there in the West Coast and Seattle and San Francisco Bay Area and so forth. A lot of new companies starting up, investing. Most of that had to do with 4G technology, opened up more opportunity for streaming for companies like Uber and others to use this because people are always in their smartphone and they've got constant information coming through a 4G network. It opened up lots of opportunities in the last decade for new investors, these disruptors, as we call them. How about into the roaring 20s? I think, like I said, I think manufacturing eventually will come back because there's got to be transition in manufacturing to what they call the fourth industrial revolution. This is investment that's going to be oriented towards AI and automation and robotics. It's going to happen. The technology is out there, but they're holding back a lot of companies on investing, and it's actually not just in manufacturing, but in a broad array of services. Also, new energy. New energy is going to come along. I mean, we've seen fracking, but we'll see more investment in new energy. We heard the president talk about nuclear, and small-scale nuclear is a possibility. So I would say there's possibilities for investment opportunities in the future. With 5G coming in, though, huge investment opportunities. This is China's whole strategy. Their 2025 strategy is all 5G. And I don't know if you follow this, but they're winning. They're winning the race. Everyone's thinking, we're fighting Huawei, and everything, but Huawei is doing great around the world. We might be trying to stop them, but that's only because I think we're paranoid about how good they're getting. You should see how many patents they're putting out, how they're we dominated 4G. They're going to dominate 5G. They're buying their chips now, not from America anymore. This is where all the chips came before, and that required investment. They're buying them in China. They're buying them from other sources because we're in this war with them. But they're doing extremely well with 5G, and 5G is going to drive a lot of investment because it opens up all kinds of, if you want to see autonomous vehicles, you've got to have 5G. And they're going to have it. They're going to have it before us. They're going to have this infrastructure in place, and that's going to provide opportunities for all kinds of investment and disruptors to come in with 5G. This is probably the most important things these presidential candidates should be talking about, in my opinion, from an economic point of view. What's happening with 5G? We're just naive. I go to the rest of the world, and China is obsessed with it. Every citizen knows about it, and they're going to get it next year before us, and then they're going to bring it to the rest of the world, except for us, because we don't want it. We're going to do it ourselves. We're going to lose investment opportunities, not just because we won't have fast download speeds, but we won't have the new opportunities to take advantage of those download speeds. For example, autonomous vehicles. This is something we should be debating and understanding more. Where the disruption is going to come from 5G, and it's going to be big, I guarantee it, in this coming decade. All right, so that's my concern, a little bit of a concern there about what's happening with our investment. Looking backward, going forward, now I want to look back again at South Carolina, focus on what's happened during the Great Expansion. Now for some good news in terms of growth, population, employment, and income. First of all, I'm having a hard time seeing my slides here, so I'm just going to have to pull this up here. Here's our overall growth in our population. You can see South Carolina, this is a retrospective on what's happened with population. In the United States, you look at the right side, and then you got South Carolina. Then there's Columbia. I want to emphasize Columbia. We hear a lot of pessimism sometimes. Columbia's not growing as fast as other parts of the state, and that's kind of true, but we're growing faster than the state overall here, and we're growing faster than the U.S. in terms of population. People do want to live here, they're moving here, and we've got a natural rate of population going as well. I've also got the South Carolina portion of the Charlotte metro area, what I think the dean was calling Charlotte, South Carolina, we call it now. So they're doing very well. Surprising in terms of population. Here's one thing that this is looking at the latest trends across metro areas, the collections of counties around metro areas, is Greenville and Spartanburg actually had slower population growth. This is our manufacturing belt where we had a lot of positive economic activity, but slower population growth in those metro areas in the upstate than even in Columbia. That's true of both the Spartanburg MSA metropolitan statistic area as well as Greenville. And then there's Hilton Head. We saw before Hilton Head growing very rapidly. I think that's why you see a bubble. I mean, you're growing so rapidly down there. Hard time finding employment, I understand that. But that's off the chart compared to what is happening to the rest of the state. So I see you're up against something the rest of the state hasn't quite experienced as much, except for Charleston. And you're going to see Charleston's the real standout here by all the measures. They're doing well in terms of population growth, greater than the state average. So you can see all these metro areas doing pretty well. except in terms of population of Greenville, Spartanburg, maybe that's not such a bad thing to have such rapid growth in population. What about jobs? Again, looking at the retrospect of what's happening during this great expansion, overall jobs in the U.S., you can see on the right side there in terms of the growth rate, but South Carolina pulling ahead in terms of jobs over this decade. We did very well in this expansion. Charlotte metro area, Charlotte, South Carolina, also doing well. Greenville, Spartanburg, as you can see, growing jobs. Now, all these numbers in terms of jobs are below population growth. So we've got population growing faster than we got job growth, generally, except for Charleston. Charleston has been keeping up its rate of growth of jobs at about the rate of its population. And then there's Hilton Head with a very dramatic increase, and the fastest increase of all our metro areas. I should also have the Grand Strand on here. I'm sorry I don't have that one, but similar area along the coast. So coastal areas growing in population and growing in terms of jobs. And we expect that will continue. And here's the most important, I think that ultimately matters. There's different ways of measuring standards of living. We often talk about jobs, but what really matters is to most people is not just jobs, but income. When I was sitting with Bobby Hitt, Secretary Hitt before, and Dr. Van Essen came to his point on income growth. He said, that's the one I want to hear about. Is income going to grow? What's it growing next year? We're predicting 5.5%. Still growing. It's very healthy growth. Here's overall the rise in per capita income, just one measure, but I think a good measure of the relative increase in the standard of living. You can see South Carolina growing faster than the nation. But here's where I get a bit of a concern when you see Columbia. We're doing good in population, the Midlands. We're doing good in terms of jobs, not so good in terms of per capita income. We are growing, all right, so it's not a bad news story. We're just not relatively doing as well as some other areas. And that's also true, oddly, of the Charlotte metro area in South Carolina. But here's where Greenville and Spartanburg are different. Greenville and Spartanburg, remember, had fairly moderate growth in population and employment, but big increase in the per capita income. So they're doing something right with economic development there to make that happen. And you can see it up there. You can just sense it going to downtown Greenville, thriving, people spending money. You know, it's helping retail and commercial really come back, and it's one of the biggest success stories of a turnaround in a region in the country, I would say. And you see it mostly when you look at per capita income. So they're doing very well. But Charleston is doing even better. Charleston's got so many strengths right now with, of course, the announcements that came in earlier before this expansion started with Boeing, but then, and Boeing's another one, by the way, cutting back. We have Volvo, you know, not expanding quite as fast, but they've got so much diversification in Charleston, and their income levels are rising far beyond the U.S. average. It's Richland County and Lexington County, that's Columbia, they're not doing so well. Hilton Head also, per capita income not growing as much. So jobs, yes, employment growing, but income not as much. It might have to do with, of course, the character of the jobs in a retirement and tourist-oriented community. All right, but overall we're doing well, but you see the bit of a concern about what's happening here in the Midlands, relatively. Final thing I want to talk about is what's happened in the last decade during this great expansion in terms of higher education. I believe, long run, this is so important to our sustained economic growth, that we see an increase in the share of our population with a bachelor's degree. This is the working population share. We want to see that increase. We don't want to see that decrease. When we see higher shares of educated workers, especially people with a four-year degree, we see rising living standards around the country. All the successful places in the last decade have been places attracting and retaining college-educated labor. You see places like Austin, #1, and this is what they're doing so well, is increasing that share of their population with higher education. In this state, we're all major metros have seen an increase. Hilton has been kind of flat on that in terms of the share. Columbia has grown its share of educated labor with higher education. So has Greenville-Spartanburg. So has the South Carolina overall, as well as the Charlotte metro area, the South Carolina portion of Charlotte, MSA, as you can see. But this doesn't really show what's most important about higher education. It's where these jobs are concentrated. And this is important to our school. And the dean was talking about that. Where are our alumni? Where are our graduates going? Overall, they're going most significantly to Charleston. That's what we're seeing, the change in the bachelor's degree attainment or higher. These are the absolute numbers going in Charleston from 105,000 to about 143,000, the biggest increase by far. Greenville too, not population growing so much, but they're becoming a more educated region of our state. In fact, if you look at Columbia, which is the last one over there, we started in the blue at the beginning of the Great Expansion with 110,000 in our, this is the two-county region, by the way. I'm just talking about Lexington and Richland County, people with higher education degrees in their prime working years, and we increased to 126,000. All right, so about 16,000 more workers available with higher education degrees. It's increased in other areas, but look at Greenville, it's increased even more. Charleston even more, going from 105,000 to 143,000, so about a 38,000 increase. This is where there's a larger pool of educated labor. And so what matters is not just the share, but the pool, the overall number of educated workers is now the largest in Charleston. And they didn't start that way, they didn't start this expansion that way, but that's how they ended up. And that also happened if you put Greenville and Spartanburg together. So we've got these two great pools now of educated workers. And Columbia is holding up, but not doing as well. And the reason it's good to have an overall mass or pool of labor is, I mean, think about that. When we want to attract people to the Midlands for jobs, we want to attract a corporate facility, something where there's going to be professional and technical jobs, occupations available. They look at this region, they want to know that there's opportunities overall for college graduates. What's it look like? They want to be with a similar kind of level of education. And they look at Charleston and they say, well, things are very good there, and it's easier to attract people there. When we try to recruit, for example, professors to come to University of South Carolina, they say, well, but what's my spouse going to do? You know, there isn't a big enough pool of labor. We need that pool to grow. That's what's happening in major metro areas. It's happening to some extent in Columbia, but not to the extent that it has in the other major metro areas, Charleston and Greenville. Okay? So the real winner in winning college-educated labor, largest increase in the share of the adult population with a four-year degree, they're winning this marathon. Largest educated labor pool, too. That's going to translate, as it already is, into greater income growth. All right, so we're always competing a little bit. Absolutely, we're doing better, but relatively, we're lagging behind in this marathon race for economic development. So I want to just finish by talking about the challenges that we face in the Midlands. There's been a lot of discussion about that, and the hour is late, so just going to go through this quickly, because we put out a report on this for the Midlands with Ingenuity, and we're going to have another one. We have an updated report on where we stand, and that'll come out in January, so I hope you pay attention to that. But we've been monitoring this every year, what's happening in the Midlands relative to other areas around the Southeast. And generally what we're finding with the Midlands is, compared to our peers in one aspirant region, that would be Raleigh, we're lagging, and again in this race, not doing as well in terms of talent. That's educated labor, and people with high skills, STEM degrees, and so forth. We look at a lot of different indicators that go into an index of talent. We've got a good base of talent in Columbia and the Midlands, but we're definitely not Raleigh, and we're actually even below the U.S. when you look at the broad measure of talent that we measure in this report. We do have a good entrepreneurial environment here. We've got a lot of good business startups, small business activity, very healthy. But we're not attracting many headquarters, and we're not attracting corporate facilities. You know, they're creating these better paying jobs that'll keep our graduates here. We've got slow growth in professional and technical business occupations. We're finding that year after year, so we're lagging there. Also, innovative capacity. We look at a lot of things, our R&D, how much R&D is taking place, for example. And we got other measures of innovative capacity. For a university town, this is low. That's why we need this president to show leadership, to help us really step up our level of R&D. That's going to attract better companies to be around these research facilities. This is what Austin, Texas did so well. We can do it too, but we've really got to redouble our efforts to increase our level of R&D. And here's where the university can play a role. Finally, in terms of cluster development, this is what holds the Midlands back. We don't have strong economic clusters. We don't have the auto cluster like they have in the upstate. We don't have the cluster of activity that is around the port and the tourism that they have in Charleston. We've got a smattering of good things, but we're kind of weak on overall cluster development. And clusters, those are businesses, synergies of geographic proximity. When you got them, they stay in place, just like we're seeing with the auto cluster, replacing the textile cluster in the upstate. Even when you get trade wars and you get disruptions in the economy, they stay put because they want to be close to one another. The suppliers and all of the support that goes into it, and they've got the appropriate labor. Everything comes together to form a cluster. We especially like in economics, export clusters or traded clusters. Those are businesses in this concentration of activity that sell their goods and services outside of their region. This drives regional development, it drives national development, drawing in income from outside the area. That supports the retail, commercial, and other local services that depend on these traded clusters. And this is where Columbia is a bit weak. And the hour is getting late, but this is something I'd like you to think about, and we need to have more debate on and discussion where we can strengthen our cluster development. We've got something, as we know, growing in insurance, but I'm not convinced that it grew significantly during this expansion. We compete with other insurance clusters around the country. Going back more than 10 years ago, we tried to jumpstart a new cluster in hydrogen fuel cells. Does anybody remember that? You know, we made an effort. Didn't work, okay? So we got set back. I was where the university played a role, but we bet on the wrong horse. It just has not paid off dividends. But it's not that we haven't been aware of this, but it didn't work out. Here's another one. I'll just kind of close with this one, and this is nuclear. There's still opportunities in nuclear. We've got Savannah River nearby, although what I heard the president talk about is mostly opportunities for Aiken. But I think we can have some opportunities here in Columbia. But we experienced in the last 2 years, and this shows up in some of the data, one of the biggest setbacks of any place in the country, and that had to do with the disaster that happened with the nuclear plants here in Scana, and the loss of a headquarters. Very few regions have faced that. We lost our major headquarters. We're losing jobs, professional jobs as a result of that. We also made a big investment. You know the story of this, $8 billion into something that's now just a black hole, and we're still paying for it. No other region has to do this. So we really have to get serious about economic development and redoing. And we tried to build a cluster around nuclear. Unfortunately, we did it in the wrong way. And, you know, I think this was a failure of leadership. We should have known this was the wrong way to finance nuclear expansion, which was to put the capital construction costs, again, going back to investment, on our utility bill. I mean, any economist would say that's a bad incentive right there for cost overruns, and that's exactly what happened. And and so there was no accountability over that. I knew this was going on. I should have spoken out. I feel actually I should do a mea culpa. I feel guilty for not telling at this Outlook conference that no other region in the country would have done this. Why are we doing this? Well, I mean, we wanted maybe to build this nuclear cluster around here and be a leader in it, but this is the wrong way to finance it. We should have known that. I knew it, and I didn't speak out about it. Well, a lot of people didn't. I wasn't alone. We wanted this to work, and we were naive, but we made some big mistakes here in the Midlands. We can't do that in the next expansion. We got to be smarter, and we need better leadership. including from the academic community. So we need the university to play a role, as you heard from the president. The university can be and will be, and we need a new vision for how it can be a catalyst for economic development. All right? We need to boost our talent. We heard about that at the beginning of this conference. This is going to be a major challenge, I will tell you. It's not as easy, maybe, as some people think, to increase the amount of high school graduates coming into USC, if that's what we want to do, because the demographics are not in our favor. Demographics are slowing down. High school graduation is slowing down. It's going to be tough. And, you know, so we've got a smaller pool of high school graduates to try to attract. We've got, and not enough of them are prepared to make it through USC. So without a dramatic lowering of our standards, this is going to be very, very challenging, and it won't happen overnight by any means, to boost our talent base and bring them into the university and then out into the workforce. Finally, we need to boost investment. We're using the university as a role. This will help the Midlands. It'll help South Carolina. We heard the president talk about partnerships. We need these. Other universities do this, and they do it well. Partnerships like we've had with IBM and Siemens and BMW. And we need to go where the growth is. It's being spent in defense. We need to get the high end of the defense budget. The president was talking about the Army's Future Command. Well, okay, well, if that's an opportunity, we need to be taking advantage of that, because the money is there and we should be getting a good share of that, and that's going to help our university play a stronger role in economic development overall. But it's going to be a major challenge. Here I show you, if you can read it, but it shows where South Carolina stands in terms of state funding for higher education. Far below pre-recession levels in most states, but South Carolina got hit the hardest in terms of the state appropriation. Today, earlier, we heard that might be coming back. We need it in the university. It's not the only way we're going to get the university is going to help grow, but the state appropriation was hit very hard. We did raise tuition, but we also were affected negatively by one of the most significant cutbacks in appropriations from the state. Meanwhile, California is expanding. You can see what's happening out there in terms of their high-tech development. Okay, so summary. Great expansion we've had. Relatively, all regions doing well, but relatively, the Midlands not doing as well as it should. We had a number of setbacks during this great expansion, but we're looking forward to, at least I am, to the roaring 20s. But we need to prepare. We need to attract capital, find better ways to do that, use our university as leverage for that, as other regions have done, and we need to continue to cultivate our talent. So those are my major messages today, and thank you all for coming today, by the way. I know it's been a long day, but I appreciate you all staying to hear my speech here, and look forward to any questions you might have. Thank you. Okay? Yes? Electric. Easy. Yeah, it's happening. The consumer's not buying into it now, but every car company knows this is the future, just because the technology is going to be better. You know, the car is going to be less of, you know, it's going to be more of an appliance with lots of electronics. And, you know, Tesla's leading the way, but all the rest are going to follow. It's just going to take some time, and they're going to have to invest. It's not, but they don't want to invest more in the existing plants. Actually, you know, we don't make engines. I mentioned this before in South Carolina, and I used to think, well, that's wrong because BMW puts engines in China. Why don't they make them here? Well, we're not going to need them. We need, you know, it's going to be in electronics, and this is where we need to think about the future and prepare. Batteries, other things that go into the electric vehicles, that's going to be in the future. And if our university can play a role in that, I think it can, with battery technology and helping bring, you know, attract that to our state, we're going to be better off, but that's going to take some time before we see that. So it's definitely electric. Yes?
Do you think the Opportunity Zone will help attract any capital to South Carolina?
Good question. We talked about that last year. We've heard about some things starting to happen in the state. So with Dr. Von Essen, we tried to get data on the opportunity. Who's investing? Where are they? What are they doing? Couldn't get any data. They won't release any information. Not that I know about. We can't get it yet. I think it will. We've got opportunity zones. It's a significant tax break for, but it's true around the country. But I think eventually that's going to be a good thing. Tim Scott, our senator, was a leader in that. He wants to see it happen in South Carolina. But at this point, except for some anecdotal stories that I've heard of people buying some property and turning it into some housing, I haven't heard anything significant. If anybody has, let me know. But that's what we talked about last year, but they will not release data on this yet. So we don't know how good it's doing. Yeah.
What influence economy and the gig economy and the emerging experience economy? What impact are they going to have on economic development at a metropolitan statistical area level? I mean, how's that going to impact, say, Charleston?
Well, the gig economy is many different things, and more people, because the job market's good, are getting formal jobs, as we would call them, rather than more informal or part-time gig economies. But I think it provides a lot of flexibility. For example, when Dr. Van Nessen was talking about, how we have this contingent labor force, manufacturers hire people on a yearly contract, but then their demand falls, so they lay them. But they've got this fallback now, so they're not completely unemployed. So I think it's definitely a stabilizer, and that's true in all the metro areas. The other thing that I think we're seeing is more people working, I know WeWork is controversial, but in this kind of way where they're, we could do more contract work with these tech firms. Here's one vision I have for Columbia, for example, is I know this because my son works in the tech industry in the Bay Area, and no young person can afford to live there anymore. They're looking to move out, but they don't want to move their whole office. They don't want to invest in South Carolina, build an office, but they do want to hire our workers, and we've got educated labor. If we can match them in a flexible way, and I see that starting to happen in downtown Columbia, where people are working in this flexible way, but connect them with these companies that may be headquartered there. That's good for our graduates. They get good jobs, entry-level jobs coming out of school, and they can work remotely. And I think that's going to continue because except for the highly paid engineers in California, nobody can afford to live there. And they are moving out, but they still want the jobs. They want to be connected with the sector. I think if we're smart, we'll find a way to connect with them and say, look, we've got a major university here. We got 5,000, the dean was talking about it, business undergrads. They're very bright. They don't have to move to you. Give them some experience. Try them out with an internship. Bring them in, and let's get them working here and paying taxes here, get their first job here. I think there's a future to this. I'm surprised it hasn't happened more yet, but I think Columbia can do very well in this space. I really do. And that's where we should do more recruitment. It's not the answer to everything, but I think it's a huge opportunity, especially for Columbia, because we do have a good quality of life. Our graduates do want to stay here. They can afford to live here. They can buy a house, but they need a job, that has a good future to it. And so when they hear some of these companies out there that are looking to hire, if they can get a job with them early on without having the moving expense and find a way to live out there, which is just impossible. This is good for us, especially a college town like Columbia, Midlands area. Okay? Over here, yes.
I'm just curious, nothing was like farming.
Yes.
The millions of pounds of grain that are sitting in silos in the Midwest, they're getting crushed. I don't know how it is in North Carolina.
Yeah.
But do you see that as having an impact? Because January or December 15th China was supposed to say, all right, we take this much.
Yes, I know, and that we hear it's going to happen and it doesn't happen. You're right, agriculture is going to hit hard, soybeans, other sectors, maybe even, I'm not sure about chickens. I'm not sure exactly how that's affected South Carolina, but it hasn't been good. China was a major market for us. It's cut back. I don't know if it's coming back quick enough. The only good thing that I hear about from all this tariff revenue that we're pulling in now, the billions of dollars, some of that's going back to the farm sector to help them. That should be done. I think the farm sector should argue more. We're being sacrificed on the altar of your trade policy right now. We're bringing in this tariff revenue. we should get it. I think that's a legitimate thing because it has been very, very volatile and unstable and very uncertain. And I know it's affected, so we haven't done a study of this, but it's certainly, we mentioned what's going on with manufacturing and exports. Exports out of Charleston are definitely down, and it's part of that. And I don't see that resolving very quickly, even though they're supposed to commit to, these are just words, to buying, X number of tons of soybeans. But I wouldn't hold my breath on that. This trade war is going on for a while, and they want to punish us, and they want to punish the agricultural sector. They think that's a winning strategy in China. I've heard them say it.